RTX absolutely crushed its Q2 2026 internal targets. Like, they didn't just beat consensus, they completely blew the doors off the quarter.
Yeah.
We were looking at adjusted sales of $24.7 billion.
Which is just a huge number.
It really is. That's
Yeah.
a massive 16% organic jump year over year. And adjusted EPS came in at $1.89, so that's up 21%.
And they followed up that top and bottom line beat immediately by, raising the full year 2026 outlook across the board.
Right. They didn't wait around.
No, exactly. So adjusted sales guidance is bumped up to a range of $95.0 to $96.0 billion, and the organic sales growth targets moved up from the 5 to 6% range all the way to 8 to 9%.
That is a very confident raise.
Oh, absolutely. EPS is raised to $7.10 to $7.25, and free cash flow is now upgraded to $8.50 to $8.75 billion for the year. And I mean, the market obviously loved the clarity. The stock saw a really solid pop at the open and actually held those gains as the street digested the print.
So imagine holding a backlog of orders so massive that it's literally worth more than the entire gross domestic product of New Zealand.
It's hard to even picture that kind of scale.
Right. But that is exactly where RTX is sitting today. Now that those headline numbers and the guidance raise are on the table, we really have to look under the hood. So today we're taking a deep dive into RTX's Q2 earnings press release, their 10Q filings, and of course, management's commentary from the earnings call.
Lots to unpack there.
Definitely. Our mission for you, the retail investor, is to figure out if this massive backlog is actually convertible to efficient cash flow, or, and this is the big question, if underlying supply chain rot and mechanical bottlenecks are basically going to eat the margins before the revenue ever hits the bottom line.
Yeah, that's the real test here.
So let's start with the moat this company has built for itself, because that backlog number really is the anchor of this entire earnings thesis.
It is a staggering moat. RTX is currently sitting on a $289 billion total backlog.
Wait, $289 billion?
Yeah, $289 billion. That is up 22% year over year. If you break that down, you are looking at $170 billion in commercial aerospace backlog and $119 billion in defense.
I look at a number like $289 billion, and to me, a backlog this big is it's like a massive heavy flywheel.
Oh, for sure.
The initial research, the development, the bidding process, it takes immense capital and literally years of engineering just to get the wheel moving.
Decades in some of these defense programs.
Exactly, decades. But once a platform, say, a specific missile system or a commercial jet engine, once that is operational and adopted globally, that wheel is just spinning.
Right, you aren't reinventing the wheel each quarter.
Exactly. You're just stamping out highly profitable units and, maybe more importantly, servicing them for decades.
Yeah.
It creates this intense gravitational pull on future cash flows that becomes highly predictable for investors.
Yeah, you aren't guessing if the revenue will materialize next quarter. You're just kind of waiting for the accounting department to recognize it.
Right.
That is exactly how you have to analyze long-cycle industrial companies. And what is really fascinating here is the sheer force keeping that flywheel spinning right now. Q2 alone saw $43 billion in new awards added to that pile.
$43 billion in a single quarter.
Yep. To put that in perspective, nearly $20 billion of that $43 billion landed at the Raytheon segment alone.
Wow.
The momentum is compounding, which is really why management felt so confident raising that full-year guidance we just talked about.
Okay, well, let's unpack the segment financials and see how RTX is actually executing against that demand, starting with the commercial side, which, as you said, makes up $170 billion of that total backlog.
Right, the bigger chunk.
Yeah. Let's look at Collins Aerospace first. They posted $8.21 billion in sales for the quarter, generating a very healthy 16.7% adjusted margin.
That's solid.
It is. And that performance was driven by a 26% surge in commercial original equipment, or OE, across both narrow-body and wide-body platforms.
Right. Well, you have airframers like Boeing and Airbus trying desperately to ramp up production to meet post-pandemic travel demand.
And they just can't build them fast enough.
Exactly. And Collins supplies the crucial systems for those planes. Everything from avionics and flight controls to the actual seating and landing gear.
Right.
But you have to contrast Collins's boom in new equipment with their engine business over at Pratt & Whitney. Pratt delivered $8.89 billion in sales, but that was actually fueled by a massive 25% jump in commercial aftermarket.
Okay, let's explain why that aftermarket is surging so hard right now. Because it ties together. It goes right back to those airframers struggling to deliver the new planes.
Yep, it's all connected.
Because new aircraft deliveries are delayed by supply chain shortages across the broader industry, airlines are basically forced to fly their older equipment much longer than they originally planned, right?
Exactly. They have no choice.
So that means more frequent engine overhauls, more replacement parts, more high-margin repair work. It basically turns older engines into an absolute cash cow for Pratt.
Yeah, and the aftermarket is where the real margin is made in the engine business anyway,
Because the initial sale is pretty tight.
Right. The initial sale of the engine often carries a very slim margin. Sometimes it's even a loss leader. But the decades of servicing it, that's what generates the actual profit.
Wait, I have to push back here and ask you to clarify something, because I'm looking at these exact same segment tables, and this is where retail investors get tripped up.
Sure, what are you seeing?
If Collins saw a 26% jump in commercial OE, because airframers are ramping up whatever they can, why did Pratt and Whitney report an 8% decline in commercial OE?
Yeah.
Like, how does Collins boom in new equipment while the primary engine manufacturer drops? That doesn't make sense on the surface.
No, it's a great question, and it is a perfect example of why you have to read the footnotes and not just the headline tables.
Okay, so what's the actual story there?
So Pratt actually did see an increase in the sheer volume of large commercial engine deliveries. They shipped 260 large commercial engines this quarter compared to 227 in Q2 of last year.
Wait, so they shipped more physical metal, but revenue went down. How does that work?
It comes down to what management called an unfavorable large commercial engine mix.
Okay, meaning what exactly?
In aerospace, not all engines carry the same upfront price tag or accounting profile. A legacy NG platform might be sold at a steeper discount to an airframer just to secure those decades of aftermarket service we were just talking about.
Oh, I see.
Whereas a newer engine might have a totally different revenue recognition profile based on the specific contract terms. So, this quarter, the specific models Pratt delivered happened to carry lower upfront revenue yields compared to the mix that they shipped last year.
So the volume of metal out the door actually went up, but the revenue mix was unfavorable, and that accounting reality more than offset the increased physical delivery volume.
Exactly.
So this isn't necessarily a sign that Pratt is losing market share or like stalling out on the assembly line. It's just the lumpiness of long-term contract accounting showing its face in a single quarter.
Precisely. It's a timing and mix issue, not a demand issue. And there is a major positive milestone for Pratt's future OE pipeline that proves they are still moving forward technologically.
What is that?
The GTF Advantage engine just received EASA certification, that's the European Union Aviation Safety Agency, for the Airbus A320neo family.
Which follows the FAA certification they got back in February.
Right, exactly. And with the first production engines delivered in this quarter, the GTF Advantage is expected to officially enter service later this year.
That's a big deal.
It's a critical step. The GTF Advantage delivers higher thrust, it runs cooler, and it provides better fuel efficiency. Capturing that next generation of narrow-body aircraft is how Pratt secures the next 30 years of aftermarket revenue.
Okay, so commercial aftermarket is clearly the cash cow right now, keeping the top line growing at Pratt while the OE mix sorts itself out.
Yep.
But I also see 23% military growth at Pratt & Whitney. And it is really fascinating that Pratt's military engines are doing so well because it proves a larger point about RTX right now.
Which is?
Global defense spending is acting as a massive safety net for the whole company. When you look at Raytheon's specific numbers, you see exactly how big that net is.
You really do. I mean, let's look at Raytheon's blowout quarter. Top line sales of $8.27 billion, which is up 18% organically.
Wow.
And the bottom line is even more impressive, a 29% jump in operating profit coming in at $1.04 billion.
What's moving the needle here is high-demand, highly sophisticated munitions and defense systems. We're talking higher volume and favorable mix across Patriot programs, Standard Missile, and AMRAAM.
Yeah, the demand there is just unprecedented.
It is. The specific backlog numbers at Raytheon tell the whole story of global demand, like $5.1 billion for GEM-T effectors, $4.1 billion in classified and confidential awards, $1.8 billion for AMRAAM, and $800 million for LTAMDs.
Okay, we need to pause here because the defense sector absolutely loves its jargon, and we can't just throw an alphabet soup of acronyms at the listener.
Fair point, yeah.
Let's break down what these systems actually are and why governments are literally pouring billions into them. You mentioned they booked $800 million for LTAMDs. What is that?
So LTMDS stands for Lower Tier Air and Missile Defense Sensor. It is a next-generation 360-degree radar system designed to replace the older radars used in the Patriot system.
Right, because the old ones were pretty limited.
Exactly. The legacy radars essentially had blind spots. They looked in one specific direction. LTMDS looks everywhere simultaneously. which is absolutely critical today when you are trying to defend against modern, highly maneuverable threats.
Like hypersonic missiles.
Hypersonics
Right.
or even coordinated drone swarms that can attack from multiple vectors at once. You need a radar that sees everything.
Right. And then you have AMRAAM, which they booked 1.8 billion for. That stands for Advanced Medium Range Air-to-Air Missile. It is essentially the standard issue beyond visual range weapon for fighter jets globally.
The go-to missile for a dogfight.
Basically, if an F-16 or an F-35 needs to shoot down an enemy aircraft from, say, 50 miles away, they're very likely using an AMRAAM.
Makes sense.
And the 5.1 billion for GE-man adductee effectors. Those are the actual physical interceptor missiles fired by the Patriot battery to knock incoming tactical ballistic missiles or aircraft out of the sky.
So when we look at the current geopolitical landscape, allied countries aren't just stockpiling basic artillery shells anymore.
No, they're going high-tech.
Right. They are frantically upgrading their entire integrated air defense architectures. And here is where it gets really interesting for the financial side of the defense business, the book-to-bill ratio.
Oh, yeah.
Raytheon posted a 2.42 book-to-bill in Q2 and a 1.77 over a rolling 12-month period.
Let's explain why that metric is basically the holy grail for defense analysts. The book-to-bill ratio measures the amount of new orders coming in compared to the amount of completed orders being billed out as revenue.
Right. Money in versus money out.
Exactly.
Yeah.
So a ratio of 1.77 means that for every single dollar of revenue Raytheon recognized and billed out over the last year, they booked $1.77 in brand new business.
They are filling the bucket almost twice as fast as they can empty it.
Which is an incredible problem to have.
Seriously. And that is exactly how you build a $119 billion defense backlog.
It is the ultimate indicator of future revenue predictability. And if you look closely, defense isn't just a Raytheon story. It is a cross-segment narrative lifting the entire company.
Right, because Collins Aerospace isn't just building commercial aircraft seats and landing gear.
No, they have a huge defense footprint, too.
Yeah, their collaborative mission autonomy software, which is called Sidekick, was just down-selected for the competitive production phase of the U.S. Air Force's Collaborative Combat Aircraft Program, the CCA.
We should take a second to explain why that software contract matters so much.
Go for it.
The CCA program is focused on developing autonomous AI-driven drones that act as wingmen for manned fighter jets like the F-35.
Sounds like something out of a sci-fi movie.
It really does, but it's happening. And the Sidekick software enables that human-to-machine teaming. It allows a single human pilot to seamlessly command multiple autonomous drones in a contested combat environment.
Human-to-machine teaming is the holy grail of next-generation defense strategy, isn't it?
Oh, absolutely.
It multiplies the force of a single pilot without risking more human lives. The fact that this next-gen defense tech is living inside the commercial aerospace segment of Collins just shows how integrated RTX's capabilities really are.
And we already mentioned Pratt & Whitney's 23% military growth earlier.
Right.
That was driven by higher F-135 military volume, which is the engine that actually powers the F-35 Lightning II-07 fighter jet. So the global defense spending environment is literally lifting all three of RTX's distinct segments simultaneously.
So what does this all mean for the bottom line? With top-line growth and both military and commercial volume looking incredibly strong across all three segments, the final piece of the puzzle for you to evaluate is whether management is actually converting this into efficient cash flow.
Right. Are they making actual cash?
Exactly. Are they keeping costs in check as they scale?
Well, let's outline the cash flow story. RTX generated $3.5 billion in operating cash flow for the quarter.
Which is very strong.
It is. You subtract out the capital expenditures, the money they have to spend on factories and equipment just to keep the lights on, and you are left with $2.9 billion in free cash flow.
And we are seeing 40 basis points of consolidated segment margin expansion.
Right.
So they aren't just selling more products. They're actually operating more profitably as they push that higher volume through their factories.
They are, and part of that margin expansion is tied to active portfolio cleanup.
What do you mean by cleanup?
Management is actively shedding non-core assets to focus their capital on the high-margin technologies we just talked about. For example, they reached an agreement to sell Raytheon's Blue Canyon Technologies business, which makes small satellites, for $620 million.
Oh, okay. And on the flip side of that cleanup, we are seeing higher restructuring costs impacting the operating profit, right?
Yeah, that's true.
Collins Aerospace, for instance, took a $64 million restructuring hit this quarter associated with their cost transformation initiatives.
It's the cost of doing business when you're realigning.
Right. These numbers look incredibly bulletproof from a distance.
Yeah.
Record backlog, rising guidance, expanding margins. But I have to ask you to temper the bullishness for a second.
Okay, let's play devil's advocate.
We have to be objective. What are the actual risks buried in the footnotes that retail investors need to watch out for? Because there is always a catch.
That is a vital question because the forward-looking statements and the gap reconciliations in the 10Q highlight several real, tangible headwinds that could threaten everything we just discussed.
Okay, let's hear them.
First, there was a $69 million litigation charge recorded in Q2.
That's not small.
No, it's not. Management considers it a non-operational expense and directly attributable to a specific legacy litigation matter, which is why it's excluded from the adjusted EPS numbers, but it still impacts the raw GAAP accounting.
Right. And as an investor, you have to remember that a $69 million charge is still $69 million of share owner money walking out the door to pay lawyers or settlements, regardless of how management classifies it operationally. You can't just ignore it because it says adjusted.
No, you really can't. But honestly, the much larger systemic operational risk is the ongoing powder metal issue.
Ah, yes. The powder metal.
Yeah. They previously identified a rare condition in the powder metal used to manufacture certain Pratt & Whitney engine parts.
Right. And this isn't a brand new issue for RTX.
No, it's been a known headache for a bit.
But it is an ongoing, highly complex one that is going to take years to fully resolve.
Yeah.
What is actually happening inside these engines? Why is it such a massive headache for the company and the airlines?
Well, to understand the powder metal issue, you have to look at how engine discs are forged.
Okay.
Pratt & Whitney uses a highly specialized powdered titanium alloy to forge high-pressure turbine discs for their engines. If that metal powder contains even microscopic impurities during the manufacturing process, it basically creates a structural weakness in the finished part.
Just from a tiny impurity.
Yes, because under the immense stress, extreme heat, and centrifugal force of commercial flight, those microscopic impurities can develop into microcracks.
So the engine could literally tear itself apart mid-flight if one of those cracks propagates and the disc shatters.
Exactly. It is a completely unacceptable safety risk.
Wow.
And because mechanics cannot simply X-ray the engine while it is still attached to the wing of the airplane to find these microscopic flaws, they have to take extreme measures.
What do they have to do?
This rare condition is requiring accelerated removals and inspections for a significant portion of the PW1100G JM-geared turbofan, or GTF, fleet.
So they have to pull the engines completely.
Yes. Airlines are being forced to literally ground their planes, drop the engines off the wings, and ship them back to maintenance facilities to be physically torn apart for deep ultrasonic inspections years ahead of their normal scheduled maintenance.
That is a massive logistical and financial undertaking.
Huge.
It has to infuriate airline customers who desperately need those planes in the sky generating revenue right now, especially when they can't get new planes from Boeing or Airbus.
Oh, they are not happy about it.
And it consumes an immense amount of engineering resources and capital at Pratt & Whitney just to handle the backlog of unexpected inspections and part replacements.
It's a drag on the whole system, and that operational bottleneck is compounded by broader macroeconomic supply chain constraints, which management explicitly calls out in the risk factor section.
Right. The supply chain is still a mess.
It is. We are talking about deep reliance on both U.S. and non-U.S. suppliers, volatile commodity markets, labor shortages at the subcontractor level, and continuous disruptions in the delivery of basic materials and services to RTX.
Yeah.
You can have all the orders in the world, but if your Tier 3 supplier can't get the specialized aluminum or the microchips they need, your assembly line literally stops.
Which leads to a final thought for you to mull over as you analyze this company and its stock. RTX has definitively proven it can win contracts.
They are absolute machines at winning business.
They really are. They have built a record-breaking $289 billion backlog, and the global demand for both their commercial aviation systems and their next-generation defense products is completely undeniable.
But the ultimate test for the stock moving forward isn't winning the business. I mean, they have already done that.
Right.
The true test over the next 3 years is whether global supply chains, labor availability, and those specific highly complex powder metal constraints will actually allow them to deliver on that massive backlog efficiently without bleeding out their margins.
Follow the show for your daily earnings coverage.